Hi everyone, it's Alex here at Session Capital Research. Welcome to our Inner Circle webinar. It's Monday the 19th of December, currently 5 o'clock Eastern for the benefit of the tape. Okay, absent any earnings this week, or we have Nike in the service on Thursday, but until then, I want to do two things today. Look at where we stand in the equity indices and also look at where the various Inner Circle model portfolios are. So that's those long-term rotation portfolios, the single stock portfolios, 4 of them, and also the short-term paper index ETF portfolio. I then want to spend some time on method. And before you switch the webinar off or leave right away for extra coffee, you may want to do that at some point, but perhaps not straight away. The reason I want to talk about method is because the market action this year, particularly in the last couple of months, but also in the first few months of the year, took a lot of people by surprise. And I think that's because the method that many people, many investors, small and large, use is wrong. And that's not to say that anyone's method is always correct, and it's not to claim any kind of particular level of skill or genius here, quite the opposite. I want to run through why we use the methods we do, and why, if used correctly, they can really help improve one's own investment and trading performance, and why I think the errors in investing and trading, if you use these methods, come down to execution. They're not conceptual, or you fail to measure a variable correctly, or you didn't look at some obscure macro thing. It comes down to execution. And execution problems, in my opinion, are much easier to solve than conceptual problems. So if method sounds boring, well, it is probably, but in my opinion, it's the key to improving your performance. There's two aspects. The first of which is get the right method that works for you, and then secondly, get better at it. So I'm going to go on to that disclaimer in a moment. We'll start with the equity indices, we'll go on to portfolio reviews, and then I want to talk method. Boring? Yes. Useful? I think it is. Let's go. So there's a disclaimer on your screen right now. This webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's go and do some equity indices. Let's get this on your screen right now. Okay, so let's start with the S&P. Now, the market on open notes you get every day, you've started to see that we've included a base and a bull case for not just the Nasdaq now, but also the S&P. And I want to walk through that on here. So this is a chart of the S&P that starts back in 2015, 2016, and the path we've been following for a couple of years now, 2-3 years now, goes back to the 2015, 2016 lows. It charts a wave 1 high just before COVID, a 2 low into the COVID crisis, a 3 high at the end of 21, a 4 low at the end of 22, and a 5 wave move up, 5th wave move up here. And until proven otherwise, that's going to remain our base case outlook. And if this is correct, as we've said many times now, it means that SPY ought to hit resistance, fail to punch through it, and roll over somewhere between, let's call it 530 and 585, that sort of range. And as we'll discuss later, there's no need, in my opinion, to anticipate that. it happens or it doesn't happen, and we can just watch at the time. I don't think there's any need to worry about it ahead of time. But it, one possibility about being wrong here, and with any securities analysis, you have to constantly focus on what if I'm wrong, is that the chart starts in the wrong place. And this has been on my mind, and I'm sort of boring individual, so this is the kind of thing I think about all day long. It's been on my mind for some time, and the reason is that 2022, I have to say, was the latter stages of the 2022 decline were more bearish than I had anticipated. So in our Seeking Alpha service, of which many of you are members, we called pretty clearly the top of the market at the end of 21. We shouted it loud and clear from the rooftops. We had a post saying buckle up. We pretty much called it. It's a call I'm proud of. Many didn't. We were, however, too quick to call a low in 22. And I mean, no one's perfect. It's okay. It's worked out great afterwards. So no particular regrets. But I always like to look at, well, if wrong, why wrong? And one possibility is that because personally I thought we were in a wave 4 down in 22, which we may well have been. Again, this remains our base case. Then the drop was more aggressive than you typically find to be a wave 4. Now you could argue, no, it's a perfectly good wave 4. It skimmed, it's the wave 4 low, October 22. It skimmed the wave 1 high here, perfectly legitimate. And that's right, but it didn't have the feel of a wave 4. It had the feel of a wave 2, a real dump. And and at the time, I remember looking at various high beta software stocks like Cloudflare and Zscaler and CrowdStrike and a bunch of others, all of which were in a large degree wave 2 down. And I found myself scratching my head thinking, well, why are they in a wave 2 down if Microsoft, for instance, is in a wave 4 down? I can't make any sense of that. And I came up with various contorted theories as to why that might be, but it could be that just Microsoft and the S&P and NASDAQ, they were all in a wave 2 down as well. So the reason that this bullish case might be correct, and the thing that got me thinking about it in the first place was, well, maybe last year wasn't a wave 4. Maybe the reason it felt so brutal was it was a wave 2, which felt brutal. Anyway, if that's true, it means that we should start the wave count at the COVID crisis lows in March of 20. That this end of 21 high here was a wave 1 up, that the low in 2022 is a wave 2 low. And if that's true, then we're in for one heck of a ride up, not just in the S&P, not just in the NASDAQ, but in a whole lot of single name stocks. And I don't know whether that's true or not yet. Again, we don't need to worry about that. But we do need to be alive to it because, again, it could be that the market rolls over and fails, and goes back to 3,500 on the S&P 500 tomorrow. That could happen, of course, but I don't think it will. I think it's either going to, on the SPY, hit the 530 to 580 range, roll over and sell off, probably pretty hard if that's a wave 5 end, or the count's wrong and it should be a 1, 2, and a 3 up. And if it's a 3 up, then it's going to keep going for some time. I don't think many people are set up for this wave 3 scenario. I mean, most weren't set up for this wave scenario. Wave 5 scenario, they're certainly not set for this wave 3. And we'll come on later about how to think rationally and calmly about this stuff. But this is the outlook on SPY right now. So July highs. So SPY as a ETF, a proxy for the S&P 500, peaked at around 460 in July. It's past that now. It's pushed right up above that sort of resistance zone here. We'll see if it turns out to support and moves on up again. I suspect it probably will. I do think we'll have some weakness in Q1. Right now what you're seeing is funds buying in order to push up the value of their stakes, in order to declare strong performance for the fund at the end of 2023, and of course strong bonus payments. Come January, February, March, that argument goes away. Now, quarterly performance is important, but it's not as important as annual. And so I wouldn't be at all surprised to see some selling in the first quarter. But I would see that selling as causing a waterfall from other market participants in order that the bigs can then scoop up more positions at the lows of the quarter. Could be completely wrong, of course, but that's my expectation, which is strong market into year end. I don't know if we're going to keep getting days like today, but market probably here or slightly above into year end, but then some weakness in Q1 will be my expectation. Let's look at the NASDAQ. Let's first of all look at the base case. Same logic as the S&P base case, which is start the count. In the case of this one, actually at the 2018 lows. Everything happens faster in the NASDAQ than the S&P. Everything happens more aggressively to the up and the downside. It's the S&P on steroids, basically. So here's the base case count for the NASDAQ, for the QQQ. 2018 lows, wave 1 high into the pre-COVID 2019 high, a wave 2 drop into the COVID crisis, wave 3 high, 2021 peak, wave 4 low, 2022 trough, wave 5 up now. And the NASDAQ of the indices is the one that's closest to the theoretical wave 5 termination zone. It's not. The NASDAQ just about made an all-time high, I think, today. The QQQ did. NQ Futures made it earlier in the week. Dow's already made it. So others are ahead of it in terms of their progress to and beyond all-time highs. But in terms of proximity to a wave 5 termination zone, this is the first index to get close to it. And so there'll be evidence here soon as to whether this NASDAQ is in a wave 5 or a wave 3 up. Because if the NASDAQ's in a wave 5 up, so too is the S&P. And if it's in a wave 3 up, so too is the S&P. Now we can look at other ETFs like XLK and a bunch of others, and we can see some evidence actually that this thing's just going to keep plowing up. But until such time as we have actual facts, we don't know. So here we have base case expectation, which is NASDAQ is very close to this wave 5 termination zone and could hit resistance and properly roll over somewhere between 418 and 463, just based on standard Fibonacci extensions, nothing more fancy than that. Bull case for the NASDAQ, here's the QQQ bull case, same argument as the bull case in the S&P, which is to say, no, the count should start at the March 2020 lows. That was a wave 1 high there, not a wave 3. So that means 2022 lows were a wave 2 low, not a wave 4. Wave 3 standard projection should take QQQ up to the 650 zone. That sounds, ridiculous to be sat here with a NASDAQ at 409 after a huge bull run all the way through 2023 that's already blistered most people. To say, well, it's going to be up another 50% before long, more than 50% up. That doesn't sound very sensible. And so I'm not sure you can look anyone in the eye and say this is a high probability case. But there's a real possibility that this happens. And I think, as I've said many times, the error, the continuous error in 22 was to be look at it. Each of these waves, what was the error in 2020 and 21 to be too bearish? What was the error in 22 to be too bullish? What's the error in 23 to be too bearish? And so constantly being on the wrong side of the market is really easy if you listen to external influences. But if you just watch the price action, as we'll discuss later, you can be on the right side of the market most of the time. So one has to be alive, I think, to the possibility that this ripper in the NASDAQ might happen. The volume profile here in the QQQ I find pretty interesting to this effect as well. So if we just look at these grey bars on the right-hand side, and let's start the clock around here. So the clock starts around April 22. Just look at the volume profiles here. This is the horizontal grey bars. This green box here, there's big accumulation here from April 22 to around May 23. Huge high volume nodes here, big buying here. It then moves up somewhat, low volume. And I think what happens here between around May and around the end of maybe October, November, is another round of buying. And I'm not sure that it's the same people that were buying down here. It could be that this is selling, but I don't think it is. I don't think that big money would sell early in a move that's going to cause FOMO amongst many, many people. I think this is folks buying that should have bought down here but didn't. Now, I think this is a second go around. Now, I think the logic, I think the underlying reason for the July to October trough was simply to give bigs an opportunity to load up here. Now, if true, then what will happen next is we'll see a whole lot of fuss about how the equity market is back and how everyone should own stocks and yada yada, and we'll see this markup zone kick in before some sort of wave 3 high and sideways action at the highs, distribution. So that's the Nasdaq bull case. Let's quickly do the Dow, and then we'll talk about the Russell sum as well. So here's the Dow DIA ETF. And this one, I will say, is easier to believe it's in a wave 5 up. And the reason for that is that the 2022 drop wasn't that deep. There's a 38.2 retrace, more or less, which isn't much. It spiked out of that really fast. We've had sideways accumulation here from October 22 all the way until November this year, so nearly a year, and now we're starting into this move up towards this wave 5 termination zone. So it could be that, again, what we should be saying is that in actual fact, that should be the start. That's a wave 1, that's a wave 2, that's a wave 3, and so on. It might be. And probably, to be honest, if that's true in the S&P and the Nasdaq, probably it's true in the Dow as well. But for now, I think it's easier to believe that the Dow hit a wave 4 low in 22 because it just wasn't much of a sell-off in 22. So we'll see. Now the Russell, let's take a really good look at the Russell. This is the IWM ETF. Now look, this is the important part. Since April 22, it's basically just been violent action, but within a sideways channel. So this has been wonderful trading for anyone who's followed this pattern. Just a constant movement from 160 at the low end to the vicinity of 200 at the top end, rinse and repeat time and time again. And we were at the level that we are now back in August 22. We were there again in January 23, again in July 23. It's rejected every single time. So there is no evidence yet that this is going to punch through here. There's no reason to assume that's the case. The move from the October lows, 160, up to the current highs at 201 has been, I think I saw the other day, it's been the fastest move from 52-week low to high ever in the Russell, something like that. So it's been brutal. And there's no reason to assume that that's going to continue and it's going to move up into markup, because so far every time it's attempted it, it's failed. So one has to assume, I think, to be safe, that the Russell's going to roll over and sell. Now, personally, a very long net long the Russell using the TNA long 3 times ETF, and I have a little tiny short position using long TZA, the inverse 3 times ETF. And I've added one more unit of TZA yesterday, as disclosed in Slack. That was poorly timed, but I own so little of the short side that it's not hurting me too much. What I'm waiting for is, does it roll over and head, for the basement again? I'm not sure it'll get back to 160, but let's say it sells off something meaningful. In which case, I want to see it actually rolling over and closing lower and lower before I start to add to those shorts. Because if it's going to move into markup, then everyone needs to get out of the way while that thing just prints money for the course of a year. Because if suddenly, the market decides to rotate capital into these small caps, and it could do because of the change in rate environment and so on, and the badly beaten down nature of the Russell compared to the Nasdaq and the S&P. We don't see the Russell anywhere near all-time highs. It's still 20% shy of all-time highs. It could do, so we could see a big run up. And what I don't want to do is poison the opportunity to make money on the way up here by anticipating a rollover that doesn't happen. Okay, let's move on and let's do some portfolio reviews. The first thing I want to do as we're doing indices is I want to look at the short-term paper-traded ETF portfolio. Now, as you recall, we started doing this back in September. It was initially something of an experiment, and the idea was, okay, we track and follow these 3x ETFs, and to trade them real time, you need to be, you need to not leave your screen basically, because if you get them wrong, they can hurt you. You sometimes need to be nimble hedging, and so the theory we had was, well, I wonder if we can use them in a model portfolio with low trading activity to try to outperform just buy and hold the S&P. And so the trading activity in this model portfolio has been tiny. Let's go right back to the start. I mean, you can see it, right? So there's a trade on the 27th of September to open the account. We'll post a list on the website soon, by the way. A trade on the 29th of September, another one on the 29th, 2nd of October, 3rd of October, a few in October, 1, 2, 3 days in November. So maybe about 10 or 11 trades on 10 or 11 days so far. And other than that, nothing. Now, on the one hand, we've been lucky, which is to say that the market's obviously been straight up. But on the other hand, we were positioned and we caught it. So it's not complete luck. Performance so far, you model a notional $1 million starting account balance. As I've said, this would work equally well with certainly somewhere between $100,000 and $1 billion account balance at the start. $10,000 is probably possible. 10 billion probably isn't, because you'd be moving the prices. It's gone pretty well. So it's about 18% up, and it's about 2/3 deployed, most of which is in the longs, and then we have some underwater shorts here. So the longs are up around $200,000 ish unrealized. The shorts are down around $25,000 ish unrealized, and there's a small amount of realized gain in here already as well, just about a tiny amount, $10,000, something like that, in that $1 million account balance. A control group here is, well, let's say on day one, we took all the money, in this case, the paper $1 million, put it all into SPY, and then went to play golf, and we did nothing. So in this control group, that would have been up 11%, still pretty fantastic, over less than 3 months just in the S&P. That doesn't count dividends, dividend reinvestment. It's just simple price of the ETF. 59% IRR, again, fantastic, and $113,000 of paper profit on $1 million account balance. Not bad for just buying the S&P and then going for a series of coffees and a few days off. But 18% up over here, 108% IRR. So the gain achieved now is better than 50% higher if you look at the absolute gain. So $112,000 over here, 183. So 50% more gains on this more active portfolio than over here. And again, we have fully 1/3 of the account still held in cash, so plenty of reserve. There's no margin modeled on this account at all, and this has been not any kind of furious trading. Now you can use these ETFs to do fantastic things and make money much, much, much faster than this. But to do that, you have to be live at the screen. And so far, the experiment of, is it possible to use these instruments to run a hedge portfolio with no wacky margin, nothing like that, but to outperform the S&P? So far, the answer is yes, and we'll see how that goes. So come January, this will be a live subscriber-only page on our website. We'll post trades as we have since inception here, and we'll keep this going through 24, and we'll see how it does. Okay, lastly, in this section, let's go over the Inner Circle portfolios. So as you recall, the notion here is this is single stock portfolios. And what we're doing here is we're using the notion of Wyckoff rotation, so this institutional accumulation, markup, distribution, markdown, to pick baskets of stocks when they look to be in the accumulation phase. In other words, baskets of stocks when they are, as a group, be it high growth or value, moving sideways at the lows. And we think that that's an accumulation opportunity. We then plan to hold them up through the markup zone for as long as that is. And that's not going to be a week. That's more likely to be a year, maybe 2, and then sell once they're in distribution mode. So we'll constantly create, hold, and wind down these portfolios as this service continues. So this is the first one that we set up. It's the core stocks portfolio, and this was set up on the 7th of February this year. I'll just open the holdings while we're at it, just 1 second. So core stocks, just as a reminder, this was Microsoft, Nvidia, Taiwan Semiconductor, and L3 Harris, which is a defense contractor. And this is how it's done. So this model's according to the following principles. There's no management fees charged here, which obviously if you're running this with an advisor, there would be. But this is just purely as if you ran it yourself. You wouldn't be paying yourself management fees. It reinvests dividends. So if Microsoft produces a dividend, the model reinvests that dividend in Microsoft stock that day. So the portfolio is up just under 62% versus 33% for the Nasdaq, 16% for the S&P, 12% for the Dow, and 2% for the Russell. So that's obviously pretty good. And if you look at each of the underlying stocks in this portfolio, they're still in our single stock analysis. They're still in either. Actually, I think they're all in hold rated now. They're all in this markup zone. So they all look to still have upside potential from here. So not planning to do anything with this portfolio just yet. The next one we set up was the high beta portfolio. That was set up on the 17th of March this year. And if we were to look at the portfolio members, the stocks in this thing were and are the Trade Desk, TTD, so ad tech company, MongoDB, MDB, database business, Zscaler, ticker ZS, cybersecurity business, CrowdStrike, CRWD, cybersecurity business, and Cloudflare NET, which is internet infrastructure and cybersecurity business. Again, the model here was it's an all-cash purchase, equal, so no margin, equal allocations, so 20% allocated to each stock, dividends reinvested, no trimming, no adding, nothing like that, just basically buy it once, leave it alone, go away. So this is, let's look at high beta now. Yeah, that's all right. So this is since the 17th of March this year. So it's up 77% on that basis. So it's better than twice the Nasdaq, which is great. Better than 3 times the S&P, better than 3.5 times the Dow, and better than 4.5 times the Russell. So not bad. And again, if we were to look at each of those stocks in our single stock analysis, they're all in the hold zone. So again, I still think there is upside to those stocks. They're not doing anything with this portfolio at the moment. Okay, next. As the year ticked on, we said, okay, the time to be buying tech and growth is sort of done. That was a Q1 2023 opportunity, and we thought that, okay, that might be bumpy road ahead. I mean, I wouldn't have called that as a 77% portfolio in the course of 9 months. That's pretty remarkable. Doesn't happen often. But I think it had a good shot to be up because tech was so beaten up and so unpopular that it couldn't help be under accumulation, in my opinion. As the year went on, we said we will create a new one in financials. And the reason to do that was because there was a lag in the buy of financial stocks. XLF, the ETF, was going nowhere. In general, it's somewhat true to say that you want to see financials participate in any rally for it to be a true broad and sustainable rally, and that wasn't happening. What it did look like was after the banking crisis in the March, when, as you recall, Silicon Valley Bank and a bunch of others went under, it looked like a bunch of banks and other financial names were under accumulation, whilst fear was still running in the streets of those names. And so far, this has done pretty good. Now, a portfolio like this is probably never going to have quite the upside that you get when you call high growth tech correctly. So that's why we just measure them against the indices. It'll be quite remarkable if you've got an 80% return on this sort of thing in a year. But if they beat the indices, then we can think that's pretty good. So again, let's look at the constituent parts of this thing. So in here we have, again, 5 names split equally: Bank of America, Bank of New York Mellon, Blackstone, Citigroup, and Chicago Mercantile Exchange. Let's see how that's done. So since inception, up about 18.5%, placed 13 for the Nasdaq, 13 for the Dow, 11 for the S&P, and 10 for the Russell. So pretty good. pretty good, pretty happy with that. Lastly, the most recent basket we formed was the Dowtard, so-called Dowtards, which was to say laggards of the Dow, which was set up in July of this year. And the reason for that was value stocks had lagged. Value stocks really had not participated in the rally at that point. And we thought, well, that probably won't last. The Dow itself was lagging, and then we went looking for which stocks within the Dow are lagging, but where their charts look compelling. Again, they look like they're under accumulation. And let's look at the members here. So the members of this particular portfolio, again, 5 of them split equally. We're in our Disney, Home Depot, Intel, Nike, and Dow Chemical. Again, same model, all dividends reinvested, no changes portfolio, no ads buys, no ads moves, changes, nothing, just bought once, go play golf. So up 15 points since 11th of July, plays 12 for the NASDAQ, 11 for the Dow, 8 for the S&P, and 4 for the Russell. So again, you're not, it's unusual in my experience to have a portfolio of Dow names outperforming the NASDAQ, particularly on the strength the NASDAQ's had this year. That probably won't last, I suspect. So I would expect the NASDAQ to overtake this portfolio in the end. But if this can outpace the Dow, if it can outpace the Russell over a period of years, then I'd be pretty happy. So that's portfolio review. Now, before we go on to method, why don't we do questions and comments if anyone's got them. If you're new here, by the way, and many are, thanks for signing up for this Inner Circle service. If you're new here, then we run these things on Ask Us Anything open mic basis. So if you have any questions at all, many ways you can ask them. 1, open the mic and shout into the system. 2, use the Slack chat channel to post questions. Or 3, use the chat or question function here in the webinar platform. So if we have any questions so far, now's a great time before we go on to very boring method matters. Anyone got anything? No. Okay.
Hey, Alex, this is Al.
Oh, hey.
Yeah, so how do you decide in the paper portfolio what's the ratio of longs to shorts? Is there a method to it, or is it just, I don't know, whatever it is? Yeah.
The overriding method is I'm scared of shorts. And it's a silly point, but it's not a silly point, which is, for all of history so far, US equity markets have gone up. And say for the occasional year, the dominant side of a hedge portfolio in US equity indices ought to be up. We started this in September when there'd been quite a big sell-off from the July high to this, and it kept selling off a bit after this was set up, not much, but a bit. And I felt that it would be dangerous to load up too much on shorts because it looked like we were going to get a rally into year end. I didn't want to have no shorts because I like to have a little bit of short exposure as a shock absorber if the market rolls over, and to then, you can always average down the entry costs of these shorts. If you look at the SQQQ, entry price here is 1844 on average, currently 1374. So it's quite a delta, it's 25% down, but on a tiny quantum. And so there's no particular science to these particular ratios, and they're drifting up over time. As long as one does nothing and the market goes up, these ratios are going to go up. But the design was try and keep the short positions small. When we started this, it also had Russell instruments in here. So we had TNA for the long and TZA for the short. But I find it too crazy an index. I have a big exposure to the Russell personally, and that's working brilliantly now, but it's been brutal for parts of the year. And it's too crazy, and it's a bit less predictable, at least in the methods we use, compared to the other indices. So we took profits on TZA, the short side, and TNA, the long side, earlier this year. And right now, I don't want to add to these shorts at this point. I want to see the market properly selling off before I add to these shorts. I don't want to add to the longs because, the prices have extended probably, and also that cash balance there, that 34% cash balance, I want to keep that in our pocket, as it were, to add to the shorts as and when needed, because there's no margin facility on this model portfolio. So that's a long answer, I'm sorry, but basically by design was keep the short side low because the portfolio was formed in September, and I thought we were going to get a rally into year end. I didn't want no shorts, and I didn't want to build shorts as the market is rising, because that's a great way to hurt yourself. Mistake I made this year, for instance, was from March to July, I had a big long TQQQ position, which did great, but I hurt myself by building a short SQQQ position too quickly, and then I made it worse by selling the SQQQ for a loss. Whereas if I just sat tight and sold it in October, November, I could have made some money on it, or a smaller loss. And again, I mean, overall, my best percentage year ever, but by quite a way. So it's been fine. But the loss that hit me with wasn't insignificant, and I really don't want to repeat that error again. And so again, I fear shorts in general. So sorry, long answer.
No worries. Thank you. Yeah.
You're welcome. Anyone else, folks, before we move on to very exciting matters of method? Okay, so I'm just going to swap out the screen here for a second. Okay, right. Now, apologies if this is boring, but the reason I want to do this is because, again, all over the internet right now, in the various grown-up chat rooms that I inhabit, I'm Freudian slip, inhabit, that we run, the better for on Twitter, that there is a lot of pain right now for people who expected the market to do one thing and it's done another. And we all get things wrong all the time. Obviously, it's impossible to call this stuff correctly. But I do think there is something to be said for forming a method that works for you and sticking to it. And then, as I said earlier, where one's errors can be essentially execution, which is, you messed up with your decision making as opposed to you failed to understand what was going on and why. My background, for those of you who don't know, is I've been a professional investor for the majority of my career, which is 3 decades worth. I started in venture capital, I moved on to leveraged buyouts, and now public equities. And what that means is that I'm an absolutely trained, dyed-in-the-wool fundamentalist. So leveraged buyouts in particular, there is a huge amount of fundamental analysis in those, deep cash flow analysis. And that informs the single stock analysis that we do in the service. So what I'm about to say isn't written out of ignorance of or disrespect for fundamental analysis. And it has specifically to do with how public securities are priced. So on method, this is how we think about public securities. It's quite reductive, but it's this simple in our view. Securities pricing, meaning equities in our world, but frankly any security, is driven by one thing and one thing only, which is the demand and the supply of those securities. That's it. We as a house, me as an individual, I don't believe there's any such thing as fair value or the right price for something. I think it's a fiction, an ex post facto construction, a narrative. I don't think it's a thing. And so because I don't think there's any such thing as the correct price, I'm never surprised by the price of anything, be that high or low. So if something is up 4% in a day or down 7%, it's simply because there is either a lot of demand or a lot of supply of the instrument. Simple as that. Simple as that. What I've found since I've adopted this method is that I find it frees up 2 things. One, it rids me of almost all emotion. I'll come to execution in a minute. Execution errors, in my experience, are when emotion interferes with the logic I've just said. It frees up emotion completely. Whether the market's bright green or bright red, I don't really get excited or depressed or anything when I'm looking at the screen. It just is what it is. The question is, did I position for it correctly or not? If not, why not? And what now should I do about it if wrong? So it frees up emotion, which allows one to think clearly. And it also frees up analysis time. if you don't spend all your time wondering, well, why is Microsoft up 4% today or down 7%, or why is the 10-year yield up or down, or if it doesn't bother you why, then you get a lot more time back, because one, you can't ever know, and two, what does it matter anyway? Because the thing that you're looking for is the output. The output is the price of the security. The input, as in whatever it might happen to be that drove the demand supply, who cares? It's not relevant. If you're a journalist or you're a historian writing after the fact, okay, that might matter. But as a securities analyst, as an investor, a trader, why does it matter? So again, very simply, the thing that governs all of our work here is we believe securities pricing is driven by demand and supply of those securities, nothing else. That's it. Now, that said, I do think that pricing can be measured. And there are two ways that I think prices, again, I'm thinking principally of equities here, can be measured. They can be measured because measurement is always relative to something, right? It's relative to an absolute scale, or it's relative to something else. So if you're measuring, velocity of a traveling vehicle, for instance, it's relative to the Earth, for instance. Or it might be relative to some other moving object. So two methods of price measurement. One, relative to the fundamentals of the underlying issuer. So if you're measuring the price of Microsoft stock, you're measuring it relative to the fundamentals of Microsoft Corporation, which is the issuer of Microsoft stock. That is you could think of it as a modernist approach. In other words, the belief that, with enough thought and effort and science and mathematics, one can understand anything in the world. This is a classical or a Renaissance notion. It lies behind most scientific method and has been popular since at least the dominance of the Florentine Republic, and probably earlier. You could also think of it as an exogenous method, which is you're looking at external factors to try and understand the price of a security. So, what's the growth rate of Microsoft revenue, for instance? Perhaps that can explain what Microsoft pricing is today and what it might be tomorrow. What's the underlying cash flow margins that Microsoft achieves, or its balance sheet strength? If you can understand changes in likely cash flow margins in the future, perhaps you can anticipate where Microsoft stock is going to be. And this is the dominant method amongst most investors. People believe that there is such a thing as fair value, that this stock is stretched because, well, the company's only growing at X% or Y%, or margins of A or B. I don't think that's how to do the job. And again, I speak as a trained fundamentalist, a very well-trained fundamentalist. The other way to measure securities is the price of a security relative to the price history of the security itself, which is, if you could think of it as a postmodern or an endogenous way, it's referencing only itself. It has no reference to anything else. So in art, for instance, one way to assess art is relative to absolute standards of artistic skill. Literature will be the same. Postmodern art criticism or literature criticism will say that, well, there isn't any such thing as absolute levels of skill. There's only the piece of art itself. Do you like it? Do you not like it? There is no reference to outside rules. Now, that's can be unpalatable in art and in politics and in music, but in securities, securities are postmodern entities. They are governed by endogenous factors, which is, again, demand and supply for the security. And measurements work better, in my experience, if you measure relative to the price history of the security itself. If you think about the security itself as a closed system. Fundamental valuation analysis, in my opinion, is interesting. It's worth looking at, but it's almost never determinative. Securities pricing relative to macro indicators, so what are equities doing relative to the 10-year yield or to GDP or something like that? Again, interesting, but rarely determinative. They can be determinative in the short term. So changes in the 10-year yield, for instance, do have some short-term impact on demand and supply for equities, for instance. Securities pricing have a relative to this historical pricing of the same securities, often, in my experience, determinative. And the evidence I would give you is technical analysis done properly works. Technical analysis is simply measuring securities pricing relative to the history of the price of that self-same security. Now, our method, I'm going to spend just a few minutes on this and then we'll finish. Our method is really simple. We use three things. One, Elliott waves. Now, there is no science in Elliott waves, in my opinion. They are a schematic, an illustration, a template, a lens through which you can view securities movements. They do not fit. Securities movements do not fit perfectly the Elliott wave schema. Of course they don't. But they fit roughly more often than one might think. And this is the simplest combination of waves here. A dominant trend up, 1, 2, 3, 4, 5 wave impulse move up, where wave 2 is a deep correction, wave 3 is a big move up, wave 4 troughs around the wave 1 high, and wave 5 gets a bit beyond the wave 3 high. And then an ABC corrective wave down. This is a typical bull market pattern. This is a move up in a security and then a temporary sell-off. This is a rip and a dip. Simple as that. If this was a bear market, you could turn those around. You'd have 5 waves down, 3 waves up. So Elliott waves are useful at the very highest level of abstraction to me to look at where are we in the move and the security. And you can apply them to short-term trends over a course of minutes and hours, or longer term over weeks and months. And they work better than you might think. There are far better Elliott wave analysts than me. Fred Frog, who's in the Circle service, is a terrific Elliott wave analyst, much more detailed, much more accurate than me, and I would encourage you to read his posts. Next, Fibonacci levels. Now, these are important because they can help you measure the amplitude of these Elliott waves. In other words, the degree of move up and the degree of move down relative to the security itself, not relative to any particular dollar price, but relative to the security itself and relative to the prior move. That's the importance of them. They are postmodern, endogenous measurements, but they work. And the reason they work is that, frankly, institutions trade them. It's as simple as that. It is a lingua franca. That's why it works. And so, again, there's a typical example on here of that bullish wave up we saw before, same green wave there. A wave 2 may terminate between the 61.8 and 78.6 reversal or retracement of that wave 1 up. A wave 3, typical termination level is around the 161.8% extension of wave 1 placed at the wave 2 low. Wave 4 down very often retests the wave 1 high, and a wave 5 high will often terminate between the 61.8 and the 78.6 extension of the length of the wave 1 to 3. That's a share price change between the start of wave 1 and the end of wave 3. Take that number, place that at the wave 4 low, and that's the zone in which your wave 5 may terminate. May. Just a probability, just a way to set expectations. And in my experience, it's best to watch and see if these terminations and reversals happen. Don't assume they're going to, just be alive to the fact they may do at these areas. But this is a measurement system just as much as meters and kilometers and velocity measurements are. It is a measurement system. It's just an endogenous, internal, self-relative, self-relating, self-referential measurement system. Finally, Wyckoff rotation. This is not measurement at all. This is behavioral. What you're looking for here is over a period of time. In my opinion, this works better in the longer term than the short term. Plenty of people will tell you this works over, seconds, minutes, and hours. Perhaps it does. But in my experience, this is better over weeks, months, and years. Sideways action at the lows, range bound at the lows, institutional buying, accumulation. Markup, rapid move up, probably low volume. That's other people. That's late money arriving, momentum hedge funds or retail arriving. Markup, why is it called markup? Because the value of the stocks accumulated by institutions in that accumulation zone is going up through no activity by the institution. They're just sat there enjoying the rise. So if you bought, for instance, this is how our portfolios are working in this service. If you bought the core or the high beta portfolio in February and March this year, you're in market right now. Sit there, do nothing, it goes up. Distributions, sideways at the highs. This is institutional selling. Markdown, institutions are done. There's no low demand for the security. There's heavy supply because retail is desperate to get out. Marked down. And that's another overlay to those Elliott waves earlier. Again, this is I've hand drawn this. This is just a scribble, but again, you'll see this apply more often than you might think. And it doesn't. It's not dissimilar to how an Elliott wave works. But what you're looking for is, again, sideways at the lows, buying, move up, That's late money coming in. The time to buy was back here. This is chasing. Chase if you like, but this is chasing. Sideways at the highs, distribution, markdown, no volume, no one's interested. Wait for this to terminate before buying, or short if you want to. That's it. That is the method we use in this service. So we do measure the fundamentals of the issuers. We're pretty sharp on that. I would challenge you to find better fundamental analysis pretty much anywhere. But securities pricing, that is demand and supply for the securities, and the best measure, in my opinion, and trying to work out where reversals may happen is relative to the historical pricing of the same security. That's it. Okay, so the reason to go on about this, on and on and on and on, is because if you can find a method like this, and I'm not saying this is the gold standard or the oracle or anything like that, it just works for me. But if you can find a method like this, you save a ton of time not stressing about, well, this thing in the news or that thing in the news. Who cares? It doesn't matter. Not stressing about, well, what if oil does this or gold does that? It doesn't matter. Who cares? So you free up time and you free up emotion. With that, you can make better decisions. And if you this way as well, you can follow the market just a little bit behind. You don't need to anticipate the market. If you are BlackRock, you need to anticipate the market. You need to be ahead of the market because anything you do moves the market. If you're most people who aren't BlackRock, it doesn't matter if you're running a $10,000 account, $1 million account, or $1 billion account. A $1 billion account does not move the market in liquid securities. And so even with modestly sized funds, maybe even a $10 billion account doesn't move markets in liquid securities. You can hang back and you can follow the market. You don't have to get ahead. You can do what the market's doing just a little bit behind. And in my experience, that's a much more accurate way to invest and trade. And I think that's what's behind so many people messing up this year, which is they were anticipating what they thought the market would do, not following the market. Speaking personally, my errors this year have been where I've anticipated a reversal that didn't happen, or the continuation of a trend that didn't happen. So two big mistakes I made in the context of an overall very, very good year. One, I took too big an exposure on the short side of NASDAQ between March and July. Again, I had the long side, so it's fine, but I cost myself money doing that, and I sold the short too soon. I should have held until October. And the other thing I did is I loaded up too much long Russell in July because I thought it was going to break up into that markup zone, and it didn't. And again, it's worked out fine, but it was painful on the way down. I didn't hedge enough on the way down either. So three big mistakes this year. Overall, great year, but those are the three painful things. And I put those all down to poor execution. So the method, I think, is good. My own errors were of execution. And that, I think, was because I was trying to anticipate something as opposed to reacting to it. You see me say over and again at the moment, react to when the market rolls over. Don't anticipate it. And that's born out of my errors this year. Again, I mean, it's been a great year, but you always have to look at where did you mess up and how can you not mess up again. We can all make different mistakes next time, but we have to try and solve for the last mistakes we made. Okay, that's all I wanted to cover tonight, folks. If you have any questions in the remaining minutes that we have, fire away. If not, then we can always discuss any of this in Slack, or if you think this is just boring as anything and you don't want to talk about it anymore, fine. But this is a way to understand how we make the calls in this service. And so I would encourage you to read it, critique it, throw rocks at it, tell me it's wrong, whatever you want to do. But this is how to understand how this service works. So any questions, comments, anything at all, folks? Okay, everyone is absolutely bored into silence. Excellent. In that case, let's wind up the webinar. Anything that comes out later, hit me up in Slack later on, or in questions on YouTube, anything you like. Thanks for being members here. Hope you continue to find the service useful. The service is growing like a wheel. It's fantastic. So thanks, everyone, and look forward to talking later in chat. Okay, see you all soon.